Welcome to the Motley Fool's Crunch Time series, where we scout out a single company from their story to their opportunities and risk. I will start with my prediction. I believe Alphabet will outperform the market over the next 5 years. Let's jump in. Alphabet is best known for Google Search, YouTube, and Android, but under the hood, it's a dual engine machine, ads and cloud. Roughly 80% of revenue still comes from search and video advertising, where Alphabet matches intent rich data with targeted ads. The second engine, Google Cloud, rents out computing power, including Google's custom tensor processing units, to enterprises that need to crunch AI workloads. The ad cash flow plus cloud growth flywheel funds a sprawling research and development pipeline, from autonomous driving at Waymo to health tech at Verily. In plain English, Google sells ads and is investing a lot in research and development. Now let's look at opportunities. First up is generative AI. Google already runs nearly every search through machine learning models. Next, if you start to layer generative summaries on top, it could deepen user engagement and eventually enable a new sponsor format. Second is cloud upsell. Google Cloud just hit profitability and is growing north of 25% year over year. If it merely closes half the gap with Microsoft Azure, annual revenue could top about $75 billion by 2030. Third is the subscription flywheel. YouTube Premium, Google One, and Play Pass have passed 270 million paid seats, giving Alphabet a recurring revenue cushion that isn't tied to ad cycles. Finally, there's optionality. If Waymo or another other bet lands even a mid-single digit market share in a multi-billion dollar industry, it could add a meaningful kicker to the valuation. Next, let's look at risk, and no sugarcoating it, right? Alphabet wears a regulatory bullseye. Antitrust suits could force the company to loosen its grip on default search deals or even split off pieces of the ad stack, trimming margins. Next, you have search disruption, which is the second worry. ChatGPT, Perplexity, and TikTok search nibble at the edges of Google's dominance. If users skip the search box, ad clicks disappear. Third is margin pressure. Generative AI inference isn't cheap, and traffic acquisition is costly. For example, payments to Apple, Samsung, and carriers already run about $15 billion per quarter. Now, my prediction. Taking the good with the bad, I'm modeling 12 to 14% annualized total return from today through 2030. Mid-teens earnings growth, buoyed by buybacks, plus a modest dividend, but volatility is still expected. Expecting a bumpier ride than a plain vanilla index, as regulatory headlines could swing the stock 20% either way, and a recession would chill the ad budgets. Still, with $95 billion in cash and a widening moat in AI, I see more upside than downside. To recap, Alphabet's ad and cloud are a cash flow machine, and its biggest growth lever is embedding AI everywhere. Now, the biggest headache is obviously regulators and things that can happen with recent regulations. I'm sticking to my call of double digit annual returns, with the stock ending much higher than it is today. At the Motley Fool, your comments make us all smarter. Please comment with your own research and insight about Alphabet and tell us what stock you want to see Crunch Time tackle next. Go to fool.com/invest to receive the top 10 best stocks to buy now.